Drop tracker in the comments right now. 2 words. That is how I know you're here for something different. That is how I know you're not looking for hype. You're not looking for someone to tell you the squeeze is happening tomorrow for the 14th time this month. You are here because you want predictions that get tracked. Analysis that shows its work. Someone who will tell you when they are wrong, not just when they are right. Type it now, tracker. And then stay with me, because what I am about to show you is the exact kind of analysis that separates this channel from everything else you are watching. I am Name, this is the Stat Guy, and today is my first weekly update since launching this channel, which means today is the first time we are going to do something that almost nobody else in silver content does. We are going to check the scoreboard. I made a specific public trackable prediction in my first video. That prediction has been sitting in the tracker for 14 days. And today we are going to look at where it stands, what the data shows, whether I was right, and what I am adjusting going forward. But that is not all we are covering. I have 3 things for you today that directly connect to whether my analysis is worth your time. First, what actually happened in COMEX inventory this week. The headline number that went viral is being misread by almost everyone. I am going to show you the primary source data and explain why the full picture is more nuanced than the clickbait version. Second, my prediction update, the specific call I made 14 days ago, where it stands right now, what I got right, what surprised me, and whether I am adjusting my confidence level. Third, a viral claim that swept through the silver community this week. I traced it back to the original source documents. The verdict might surprise you, and it is a perfect example of why fact-checking matters in this space. Let us get into it. Let me start with the data that has everyone talking this week. COMEX registered silver inventory. If you have been following silver content for more than about 10 minutes, you have heard about registered versus eligible. You have heard about vault drainage. You have heard about the paper to physical ratio. But here is what I have noticed. Most of the analysis being done on this data is either wildly alarmist or dismissively skeptical. And both of those camps are missing the actual picture. So let me walk you through exactly what the data shows this week. I'm going to show you the primary source. I am going to explain what the numbers mean. And then I'm going to give you my interpretation along with the reasoning so you can evaluate it yourself. Let me pull up the CME Group Daily Depository Report. This is the original source document, not a screenshot from another channel, not a secondhand interpretation. The actual filing from CME Group, published daily, available to anyone who knows where to look. I will link it in the description so you can verify everything I'm about to show you. As of the most recent report, COMEX registered silver stands at approximately 87.2 million ounces. Let me give you the context on that number. 1 week ago, registered silver was at approximately 88.1 million ounces. So we have seen a drawdown of roughly 900,000 ounces in the past 7 days. 1 month ago, registered silver was at approximately 94 million ounces. So month over month, we have seen a drawdown of approximately 7 million ounces. 1 year ago, registered silver was at approximately 147 million ounces. So year over year, we have seen a decline of roughly 60 million ounces. That is a drop of over 40% in 12 months. And if we go back further, to early 2021 during the Wall Street Bets silver situation, registered inventory peaked at around 150 million ounces. We are now at 58% of that level. Now, here is where the viral claims start to diverge from careful analysis. Some channels are looking at this data and screaming that the vaults are empty. They are saying default is imminent. They are saying the system is about to collapse. Other voices are dismissing the drawdown entirely. They are saying inventory always fluctuates. They are saying eligible silver can be converted to registered at any time. They are saying there is nothing to see here. I think both of those interpretations are wrong. Let me explain why. The alarmist interpretation misses several important structural factors. Factor 1. COMEX can settle contracts in cash. If delivery demand exceeds physical availability, the exchange has mechanisms to settle financially rather than physically. This is not ideal. It would damage confidence in the system. But it is an option that exists. Factor 2. Eligible silver, which sits in COMEX warehouses but has not been designated for delivery, currently stands at approximately 278 million ounces. That is more than 3 times the registered amount. This eligible metal can be converted to registered status relatively quickly, typically within 24 to 48 hours, if the owners choose to make it available for delivery. Factor 3. The market has survived low registered inventory before. In 2011, registered silver dropped to similar levels relative to open interest, and the system adapted through cash settlements, conversion of eligible to registered, and sourcing from other markets. So the collapse is imminent narrative overstates the immediate risk. But the dismissive interpretation also misses critical factors. Factor 1. The trend matters. This is not random fluctuation. Registered inventory has been declining consistently for over 3 years. That is not noise, that is signal. It represents a persistent flow of metal out of the paper market system and into physical hands. Factor 2, delivery demand has been elevated. The February delivery cycle saw higher than normal standing for delivery. January before, it was even higher. This is not speculative paper trading. This is someone, or multiple someones, preferring to take physical metal off the exchange rather than roll their contracts forward. Factor 3, the conversion buffer is not automatic. Yes, eligible silver can be converted to registered, but that requires willing sellers at current prices. If the owners of eligible silver believe prices are going higher, why would they rush to convert and sell into what they perceive as a suppressed market? The eligible buffer exists on paper. Whether it can be mobilized quickly at current price levels is a genuinely open question. Factor 4. The context is different now. Industrial demand for silver has structurally increased. Solar panel production alone now consumes approximately 140 million ounces annually, up from negligible amounts 15 years ago. Electric vehicle production, AI-related semiconductors, and medical applications are all growing their silver consumption. This is not speculative demand that can evaporate. This is industrial demand with few substitutes. So here is my actual read on the COMEX data. The silver market is under moderate but real structural pressure. Registered inventory at 87 million ounces, with approximately 280 million ounces of open interest representing claims on that metal, creates a mathematical tension that the market must resolve over time. The resolution can come through higher prices that incentivize conversion of eligible to registered. It can come through cash settlement premiums that make physical delivery economically unattractive. It can come through a genuine delivery squeeze if standing demand exceeds available supply in a particular month. I do not know which resolution path we will see. Anyone who tells you they know with certainty is overstating their knowledge. What I can tell you is what the data shows. Persistent drawdown trend, elevated delivery demand, structural industrial consumption. These are facts, not speculation. And what I can tell you is how this connects to my prediction tracker. When I made my first prediction 2 weeks ago, the COMEX inventory situation was part of my reasoning. The data has not changed dramatically since then. The drawdown has continued at roughly the pace I expected. The delivery patterns have remained elevated, so from a fundamental standpoint, the thesis underlying my prediction remains intact. But let us look at the price action, because that is what actually determines whether my prediction hits or misses. This is the part of the video that makes this channel different. I made a specific prediction in my launch video. That prediction went into the public tracker immediately, and now 14 days later, we are going to evaluate it. Let me pull up the tracker. Here is what I committed to. Prediction number 1. Silver spot price will close above $36 at least once during the next 45 days from the date of prediction. Date of prediction, February 15th. Time frame expiration, April 1st. Confidence level, moderate. Reasoning at time of prediction. Current inventory trends plus seasonal demand patterns plus technical support levels suggest continued upward pressure. However, significant resistance exists at $35, and a broader risk-off event could pull silver lower despite fundamentals. What would prove me wrong? A sustained break below $31 on high volume would indicate the bullish thesis is failing. That was the prediction. Specific, measurable, falsifiable, with clear reasoning and a clear invalidation level. Now let me show you what has happened in the 14 days since. Silver closed on February 15th, the day of my prediction, at approximately $33.40. Over the following 2 weeks, silver traded in a range between $32.50 on the low end and $35.20 on the high end. As of yesterday's close, silver sits at approximately $34.70. So where does this leave my prediction? The target was $36. We have not hit it yet. The highest close in the 14-day window was $35.20, roughly 80 cents below the target level. But the time frame is not expired. I have 31 days remaining until April 1st. The prediction is still live. Let me evaluate the path so far. What I got right? The directional bias. Silver has traded higher since my prediction date. We went from $33.40 to $34.70, a gain of approximately 4%. The general upward pressure I identified has materialized. What I got right? The support level. I said $31 was the level that would invalidate my thesis. Silver never came close to that level. The lowest print in the 14-day window was $32.50, a full $1.50 above my invalidation zone. The support structure I identified held. What surprised me, the resistance at $35 has been stickier than I expected. Silver has approached 35 multiple times and been rejected. This level is acting as a more significant ceiling than I anticipated. My thesis assumed we would break through 35 relatively cleanly on the way to 36. Instead, we are grinding. What I am watching now. The consolidation pattern below 35 is setting up what technical analysts call a coiling formation. Price is compressing into a tighter range. Volume on the down days is declining. This typically resolves with a directional breakout. My bias remains that the breakout is more likely to be upward than downward based on the fundamental factors I outlined, but I am watching carefully. Now, the question: am I adjusting my confidence level? Here is my honest assessment. The fundamental thesis remains intact. COMEX inventory continues to draw down. Delivery demand remains elevated. Industrial consumption is not declining. Nothing in the underlying data has changed in a way that undermines my original reasoning. The price action is consistent with the thesis, just slower than I might have hoped. We are up 4% in 14 days. That is not explosive, but it is not bearish either. The resistance at 35 is a factor I underweighted. I should have given more attention to this level in my original analysis. It has been tested multiple times and held. That tells me the sellers at 35 are real and well capitalized. So here's my adjustment. I'm keeping the prediction as stated. Silver above 36 by April 1st. I'm not changing the target or the time frame, but I am adjusting my confidence level from moderate to moderate low. Let me explain why. When I said moderate confidence originally, I was implying roughly 60% probability of hitting the target. Based on the stickiness of the 35 resistance and the slower than expected pace of the move, I'm revising my mental probability down to approximately 50 to 55%. I still think it is more likely than not that we see 36 before April 1st. But I'm less confident than I was 2 weeks ago. The invalidation level remains $31. If we break below 31 on volume, the thesis is broken, and I will log the prediction as a miss, even if the time frame has not expired. Now, I want to be very clear about what this adjustment means and what it does not mean. This is not me hedging, because I think I am going to be wrong. This is me updating my probability estimate based on new information. The price action gave me information I did not have 2 weeks ago. That information is that 35 is a significant resistance level. That changes my probability estimate. This is exactly what honest analysis looks like. You form a thesis, you make a prediction, you observe the market, you update based on what you learn, and you document all of it publicly. If I hit the 36 target in the next 31 days, I will log it as a win. But I will also note in the analysis column that I adjusted my confidence downward midway through the period. Full transparency. If I miss the target, I will log it as a miss, and I will analyze what I got wrong. Was it the fundamental thesis? Was it the timing? Was it the specific level? What would I do differently? Either way, you will see the complete record. No hiding, no memory holding, no pretending the prediction did not exist. That is the accountability promise. Let me give you one more piece of context before we move on. I have been tracking other silver predictions made around the same time as mine. Not to call anyone out, but to calibrate my own sense of where I stand relative to the broader community of analysts. In the 2 weeks since my prediction, I have logged 11 specific price predictions from other silver content creators, channels with subscriber counts ranging from 10,000 to over 500,000. Of those 11 predictions, here is the breakdown. 3 predictions were too vague to evaluate. They said things like, silver is going to explode, or big moves coming, without specific price levels or time frames. These are not predictions, they are vibes. 4 predictions had specific price targets, but no time frames. Silver to $50, without saying when. These are also not evaluable because they can never be proven wrong. 2 predictions had specific prices and time frames, but have already been proven wrong. One called for silver above 40 by end of February. We closed February at 34.70. Miss. Another called for silver below 30 by mid-March. We never came close. Miss. 2 predictions remain live with time frames that have not expired. I'm tracking them alongside my own. The point of this exercise is not to gloat when others are wrong. The point is to demonstrate that most silver predictions are not structured in a way that allows for accountability, and to show you that when they are structured properly, the hit rate is not 100%. Predictions are hard. Markets are uncertain. Anyone who is right all the time is either not making real predictions or is not being honest about their misses. I am going to be wrong sometimes. The question is whether I own it and learn from it. That is what this tracker is for. Let's talk about something that swept through the silver community this week. It's a perfect example of why fact-checking is so incredibly important, especially when it comes to your money. You've probably seen a claim making the rounds on Twitter, YouTube, Reddit, and all over the silver forums. It went something like this. JP Morgan just closed $5 billion in silver short positions. The banks are capitulating. The short squeeze is confirmed. I saw this claim shared hundreds, if not thousands of times. I saw it cited in multiple videos that got tens of thousands of views. It was discussed in forums as if it were a solid, established fact. And you know me. When I see a big specific claim like that, I do what I always do. I go looking for the primary source. And here's what I found. The claim seems to come from a major misreading of the CFTC's bank participation report, likely combined with a misunderstanding of the commitments of traders' data. Let me walk you through what the actual data says, because the difference is huge. The bank participation report is published monthly by the CFTC. It shows the combined futures and options positions of the largest U.S. banks and the largest non-U.S. banks in different commodity markets, including silver. It gives us a peek into what the big players are doing. The most recent report, which covers positions as of early February, shows that U.S. banks held a net short position in silver futures, and options of about 35 million ounces. Okay, now let's look at the previous month's report. That one showed a net short position of approximately 42 million ounces. So if we do the math, U.S. banks reduced their net short position by about 7 million ounces between the two reports. That's a reduction of roughly 17%. Now let's put a dollar value on that. With silver prices hovering around $34 per ounce, that 7 million ounce reduction equals approximately $238 million in notional position reduction. And let that sink in. $238 million, not $5 billion. The viral claim wasn't just a little off. It overstated the actual change in the bank's position by a factor of more than 20. That's not a rounding error. That's a completely different story. So how on earth did this happen? How do we get from 238 million to 5 billion? I traced the claim back through several layers of sharing, like a detective following a trail. Near the origin, I found a post that seems to have calculated the total value of the entire bank short position, not the change in the position. Someone took the total notional value of all bank silver shorts, which was around $2 billion at the time, and then somehow, as it was shared and reshared and amplified, that number morphed into closing $5 billion in shorts. But then, you combine that with some careless math or misunderstanding of the report. This gets amplified by people who are excited and want to believe it, and before you know it, it becomes an established fact across the community, despite being wildly inaccurate. So let's clear the air and focus on what the primary source data actually tells us. Let's separate the facts from the fiction. Fact: U.S. banks have been reducing their net short position in silver over the past several months. This is absolutely true, and it is significant. For years, we've talked about these large short positions held by banks as a major headwind for silver. Seeing them reduce that exposure is a noteworthy development. Here is another fact. The December 2025 bank participation report showed U.S. banks briefly flipping to a net long position in silver for the first time in recent memory. This is verified. I pulled the report myself. It's real, and it was a big deal. And a third fact. The overall trend in bank positioning has shifted from being heavily short to approximately neutral over the past 18 months. This isn't just a one-month blip. It's a structural and meaningful change in how these major institutions are positioned in the silver market. Now, for what is not a fact. Banks did not close $5 billion in shorts this month. That did not happen. The actual reduction was around $238 million. The viral claim was a massive exaggeration. So why does this distinction matter so much? Why am I harping on this? Because false precision destroys credibility. Think about it. If you tell someone, hey, the banks just closed $5 billion in shorts, the squeeze is on, and then they decide to go look at the actual data for themselves and see the number was really 238 million, what do you think their reaction is? They don't think, oh, well, the direction was right, just the magnitude was a little off. No, they think, I was lied to. I can't trust this source. And once that trust is broken, they start dismissing everything from that source, even the legitimate, valuable analysis. The silver community, let's be honest, already has a bit of a credibility problem in the wider financial world. And every single time a viral claim like this turns out to be exaggerated or completely false, it damages the trust in the entire ecosystem of silver analysis. It makes all of us look less serious. This is why I fact-check everything. It's not because I get some kind of kick out of proving people wrong. It's not because I think I'm smarter than everyone else. It's because accurate information is the absolute foundation of making good decisions, especially good financial decisions. If you are basing your investment choices on the idea that banks closed $5 billion in shorts, you are operating with false information. That could lead you to be way more aggressive than you should be. It could lead you to take on risks that aren't justified by the actual underlying data. And it could lead to massive disappointment when the rocket ship you were promised doesn't take off on the timeline you were sold. Getting the facts right matters. It's everything. Now, let me be very clear about what the accurate data does and does not tell us. The accurate data tells us that bank positioning in silver has fundamentally shifted over the past year and a half. This is real. This is significant. It removes one of the traditional headwinds that silver bulls have complained about for years, and that is a bullish factor. However, the accurate data does not tell us that a massive short squeeze is guaranteed to happen tomorrow. A reduction in a short position is not the same thing as a complete position reversal. Banks reducing their exposure from heavily short down to neutral is a very different scenario from those same banks suddenly going massively long. The fuel for a squeeze, a tight physical market and strong demand, is certainly there. But this data point alone is not the spark that lights the fuse. The truth, as it so often is more nuanced than the viral, headline-grabbing version. The accurate data supports a constructive, long-term bullish view on silver without needing to rely on wild claims about imminent, explosive moves. The real story is compelling enough on its own. So, here's my final verdict on this viral claim. I'm rating it as misleading. The directional part of the claim, that banks are reducing their short positions, is accurate. But the magnitude, the $5 billion figure, is false by a factor of over 20. And the implication that this confirms an imminent squeeze is an overstatement that is not supported by the data. Look, if you shared this claim, I'm not attacking you. I get it. Misinformation spreads because it sounds plausible, it's exciting, and it often confirms what we desperately want to believe. The solution isn't to shame people who fall for it. The solution is for all of us to practice better information hygiene. So, the next time you see a very specific claim with very specific numbers, just ask yourself a few simple questions. What is the primary source for this information? Where did this number actually come from? Can I find a way to verify it independently? If you can't find the primary source, or if the person sharing it can't provide one, treat the claim with a healthy dose of skepticism. Even if it's coming from a huge channel with 1 million subscribers, even if it's been shared thousands of times, and especially if it perfectly confirms your existing beliefs. Let's zoom out and get some context on what the broader precious metals market is doing, because silver doesn't trade in isolation. Gold closed yesterday at about $2,047 per ounce. That's near its all-time highs. Gold has been remarkably strong, even with a relatively strong dollar and high real interest rates. The usual negative relationship between gold and real yields has broken down, which suggests something structural is changing in how gold is being valued. Now, let's look at the gold to silver ratio. It currently sits at about 59 to 1. This means it takes 59 ounces of silver to buy 1 ounce of gold. For some perspective, the historical average over the last 50 years is around 60 to 65. So we're near the lower end of that historical range, but not at an extreme. During the big silver spike back in 2011, this ratio squeezed down to around 32. And during silver's weaker period in 2020, the ratio blew out to over 120. A ratio of 59 suggests that silver is fairly valued compared to gold, based on historical standards. It's not super cheap, but it's not super expensive either. So, what does this mean? If gold continues to push for new highs and the silver ratio stays about the same, we'd expect silver to be pulled up with it. But if that ratio compresses down towards 40 or 35, which it has done in past silver bull markets, the upside for silver could be much stronger than for gold. I'm not predicting the ratio will do that. I'm just giving you the context so you understand how these two metals are linked. Platinum and palladium have also been showing strength recently. Platinum broke above $1,000 for the first time in months. Palladium has stabilized after a long decline. The whole precious metals group is getting a lift, which tells me the move is probably being driven by bigger macro factors. Things like expectations of a weaker dollar and concerns about inflation rather than any news specific to silver. Industrial metals are also up. Copper is trading near $4.30 a pound, which is close to historically high levels. Copper and silver are often connected, since they're sometimes found in the same mines. Strength in copper supports the industrial demand side of the story for silver. The wider commodity world, including energy, is a bit of a mixed bag. Oil has been volatile because of geopolitical issues, but it hasn't broken out to new highs. Agricultural commodities are stable. The kind of commodity inflation we saw in 2021 and 2022 hasn't fully come back, but it hasn't gone away either. From a big picture macro view, the factors that would support higher silver prices are there, but they aren't overwhelming. A weaker dollar is still possible, but hasn't really happened in a big way yet. Inflation has cooled off from its peak, but is still above what central banks want. We're expecting interest rate cuts, but the timeline for those keeps getting pushed back. So the setup is constructive for silver, but it's not a screaming buy signal from every angle. The data supports a moderate bullish view, which is exactly what I've been saying. This is why my confidence level is moderate rather than high. The factors are generally pointing in the right direction, but there are enough things pushing back that I can't be super confident in a specific price target or time frame. Let me address some questions and comments from the community. Several people asked about my methodology for tracking predictions. Specifically, how do I determine when a prediction is a hit versus a miss? Here's my framework. A prediction is a hit if the specified price level is reached within the specified time frame. For example, silver closes above 36 by April 1st is a hit if, at any point before market close on April 1st, silver has a daily close above $36. It does not need to stay above 36. It just needs to touch that level once. A prediction is a miss if the time frame expires without the price level being reached. Using the same example, if April 1st arrives and silver never closed above 36, that is a miss. A prediction can also be invalidated early if the what would prove me wrong's condition is triggered. If silver breaks below 31 on volume before April 1st, I would log that as an early invalidation and count it as a miss, even though the formal time frame has not expired. Why structure it this way? Because clear rules prevent post hoc rationalization. If the rules are ambiguous, there's always a temptation to interpret results favorably. Well, it did not technically hit 36, but it got to 35.80, which is basically 36. And if you round up, no, the rule is the rule. This is what separates accountability from performance. Another question that came up multiple times: what happens if I am wrong more than I right? Here's my honest answer. If my track record over a meaningful sample size, let us say 20 or more predictions, shows that I am wrong more than 50% of the time, that is valuable information. It tells you that my analysis is not adding value. It tells you that you would be better off flipping a coin than listening to my predictions. And you know what? If that is what the data shows, I will tell you. I will publish that analysis myself. I will say, look, I have made 20 predictions, and 12 of them missed. My hit rate is 40%. You should probably weight my analysis accordingly. That might cost me subscribers. That might hurt my channel growth. But it is the honest thing to do. I would rather have a smaller audience that trusts me than a larger audience that I have deceived. And here's the thing. I do not think my hit rate will be below 50%. I have spent years studying these markets. I have developed analytical frameworks that I believe are sound. I think my predictions will hit more often than they miss. But I could be wrong about that. The tracker will tell us. Another question. Why moderate confidence instead of high confidence on your first prediction? Because high confidence should be reserved for situations where the data is screaming at you, where multiple indicators are aligned, where the risk-reward is exceptionally asymmetric. My first prediction was based on solid reasoning, but the setup was not extreme. COMEX inventory is low, but not at crisis levels. Delivery demand is elevated, but not unprecedented. The technical picture was supportive, but not an obvious breakout. Moderate confidence means I think it is more likely than not to hit, but there are legitimate scenarios where I am wrong. That felt like the honest assessment. I will use high confidence when I see a setup that demands it, when everything lines up, when the probability feels like 75% or higher. So far, I have not seen that setup in a way that translates to a specific trackable prediction. When I do, you will know, and the tracker will show whether my high confidence calls actually hit at a higher rate than my moderate confidence calls. Last question I want to address. Are you worried about being wrong publicly? Yes, of course. Nobody wants to be wrong in public. It is uncomfortable. It opens you up to criticism. It gives ammunition to people who disagree with you. But here's what I believe. Being wrong publicly and owning it builds more trust than being right privately ever could. If I make a prediction, it misses, and I analyze why in a follow-up video. That demonstrates intellectual honesty. It shows that I am more committed to truth than to ego. It shows that you can trust me to give you my genuine assessment rather than a performance designed to protect my reputation. The channels that never admit mistakes are performing confidence. They are giving you a show, and when reality does not match the show, they just move on to the next show. I would rather be real than be perfect. Let me give you a preview of what I am monitoring over the next 7 days. First, the March delivery cycle. March is a delivery month for silver futures on COMEX. First notice day has already passed. We are now in the period where contracts are being settled either through delivery or cash. I will be watching the daily delivery reports to see how many contracts are standing for physical metal versus rolling forward or settling in cash. Elevated delivery demand would support the thesis that physical tightness is real. Low delivery demand would suggest the paper market is functioning normally. So far, the March data shows elevated but not extreme delivery standing. I will update you next week on where the final numbers land. Second, the $35 resistance level. As I mentioned, this level has rejected silver multiple times in the past 2 weeks. Whether we break above it, continue consolidating below it, or roll over and head lower will tell us a lot about the near-term direction. A decisive break above 35 on volume would increase my confidence that 36 is achievable before April 1st. A break below 33 would make me nervous about my prediction. Continued consolidation in the 33 to 35 range would extend the uncertainty. Third, any follow-up on the viral claim I fact-checked today. I expect some pushback on my analysis. People do not like being told that something they believed is wrong. I will engage thoughtfully with any substantive criticism and update my verdict if someone shows me primary source data I missed. That is how fact-checking should work. I am not infallible. If I got something wrong, I want to know. Fourth, broader macro data. There are several economic releases next week that could move precious metals. I will not try to predict those releases, but I will be watching how the market reacts. A hot inflation print would likely support silver. A strong jobs number that pushes rate cut expectations further out might pressure it. The macro context matters. I do not make predictions in a vacuum. Let me bring this back to the tracker and to what this channel is about. My first prediction is still live. Silver above 36 by April 1st. Confidence level downgraded to moderate low based on the stickiness of 35 resistance. Invalidation level remains 31. The COMEX data supports the underlying thesis. The viral claim about bank positioning was overstated by a factor of 20. The broader macro context is constructive but not explosive. That is the honest assessment based on the data I see today. If you want analysis like this every week, here's what I need you to do. First, drop tracker in the comments if you have not already. That tells me this approach resonates. That tells me the accountability angle is what you want to see. It takes 2 seconds, and it helps the algorithm show this content to more people who need it. Second, subscribe if you're not already subscribed. Hit the notification bell so you know when new content drops. The weekly update will be every day, with additional videos when significant news breaks or when fact checks need to happen. Third, check the pinned comment for the link to the prediction tracker. Bookmark it. Check it regularly, hold me accountable. That is the whole point of the system. Here's what is coming next. Next video, I'm doing a deep dive into the gold to silver ratio. What does it tell us about relative value? How has it behaved in previous bull markets? And what would it mean for silver if the ratio compresses toward historical extremes? After that, assuming my prediction has either hit or the time frame is getting close, I will do a full postmortem, either celebrating the win and analyzing what I got right, or owning the miss and analyzing what I got wrong. Either way, you will see the complete picture. That is the accountability promise. Let me close with this. The silver community has been burned by false predictions more times than anyone can count. Analysts who cry wolf every week, price targets that never materialize, explanations that disappear when reality does not cooperate. I'm not going to pretend I am immune to error. I will be wrong. The market will humble me. Things I expect will not happen. Things I do not expect will. But what I can promise is transparency. What I can promise is accountability. What I can promise is that you will always know where my predictions stand, whether I hit or missed, and what I learned from both. That is not a small thing. In a space full of noise and hype and untracked claims, that is actually rare. So thank you for being here. Thank you for caring about accuracy. Thank you for holding me accountable. This is the Stack Guy, data-driven, accountable, independent. The tracker is live. The predictions are public, and we are just getting started. I will see you in the next one.